This week's working paper is a landscape episode. No single paper, by design, progress, and when the Q topic is ETF concentration and S&P 500 weighting effects from AI mega cap progress, and I believe that's a phenomenon still running faster than the academic publication cycle. Progress, and I believe So today I'm surveying 3 foundational papers that together explain the mechanism. Progress, and I believe Then I'll tell you what the current empirical situation looks like and where the gaps in the research are. Progress, and I believe The through line is what's called the inelastic markets hypothesis. The idea, progress, and I believe developed formally over roughly the last 5 years. Progress, and I believe that passive equity flows move prices far more than $1 for dollar intuition would predict. Progress layered on that is the extraordinary concentration of S&P 500 market cap weight in a handful of large cap technology and AI adjacent names through 2023 and 2024. Progress, and I believe The combination deserves careful treatment. Let's get into it. Progress, and I believe The question this episode is trying to answer is not whether AI mega caps are overvalued. Progress, and I believe That's a valuation claim I'll leave to other people. Progress, and I believe The question is structural. Does the dominance of passive index tracking vehicles, progress, and I believe combined with extreme concentration of market cap weight in a few names change how prices are formed in the S&P 500. By the end of 24, progress, and I believe the top 10 names in the S&P 500 represented a share of index weight that was high by post-1990s historical standards, somewhere in the range of a third of the index or more, by publicly available estimates. Progress, and I believe That means when $1 of new money flows into an S&P 500 ETF, a substantial fraction must mechanically be by the same handful of names. Progress, and I believe The academic literature has been building a toolkit to think about exactly this kind of demand-driven price formation. Progress, and I believe And it is considerably more rigorous than what you find in financial commentary. Progress, and I believe That's what we're going to use today. Progress, and I believe The foundational piece for this discussion is work by Gabaix and Koijen. Gabaix at Harvard and Koijen at Chicago Booth, circulating as an NBER working paper around 2021 and published under the title In Search of the Origins of Financial Fluctuations. Progress, and I believe the inelastic markets hypothesis. Their central claim is that stock market prices are much more sensitive to demand shocks than standard frictionless models predict. So using a heterogeneous agent model calibrated to institutional flows data, they estimate a flow multiplier. Progress, and I believe The authors report effect sizes suggesting that $1 of net inflow into equities moves aggregate market capitalization by a multiple substantially greater than 1, on the order of several dollars of market cap per dollar of flow. Progress, and I believe though the exact estimates vary across specifications, and I'll flag those estimates are contested. Progress, and I believe the mechanism genuine arbitrage capacity is finite. When a large passive fund must buy because index weights change, progress, and I believe there are not enough arbitrageurs willing to sell at the old price, so price moves. Progress, and I believe standard efficient market intuition says arbitrageurs should absorb these flows without any price effect. And I believe Gabaix and Koijen argue the data says otherwise. This is Ben, David Franzoni, and Moussawi. Itzhak Ben, David at Ohio State, Francesco Franzoni at USI Lugano. Progress, and I believe And Rabi Moussawi at Villanova published a paper in the Review of Financial Studies around 2018 asking a more granular version of this question. Progress, and I believe Rather than the aggregate market, they look at what ETF ownership does to individual constituent stocks. If their paper, which examines whether and how ETF ownership increases short-term return volatility, progress, and I believe finds that stocks with higher ETF ownership exhibit elevated short-run return volatility after controlling for the standard confounders. That I believe The mechanism they identify is ETF arbitrage. When an ETF trades at a premium or discount to its net asset value, progress, I believe this is. Arbitrageurs step in by simultaneously trading the ETF and its underlying basket. That is the feature that keeps the ETF price near NAV. I believe this is. But it means demand shocks at the ETF level, progress, and I believe this is. Driven by investor flows into the ETF wrapper and not by information about the underlying stocks, progress, and I believe this is, get transmitted mechanically to every constituent in the basket. Progress, and I believe this is. The authors report the effect is economically meaningful, progress, and I believe this is, particularly for stocks where ETF ownership is large relative to daily trading volume. And I believe this is. For the top weight S&P 500 names sitting inside dozens of overlapping ETFs, that coverage is substantial. Progress, and I believe this is. Ralph Koijen and Motohiro Yogo, Koijen at Chicago Booth and Yogo at Princeton, published a paper around 2019 in a top-tier finance journal developing what they call a demand system approach to asset pricing. Rather, I believe this is, rather than imposing a single price elasticity assumption, progress, and I believe this is, they estimate the demand curve of each class of institutional investor using quarterly holdings data, progress, and I believe this is, treating each investor type as having a distinct willingness to pay at different price levels. Progress, and I believe this is. The key implication for our purposes is what they find about passive indexed investors. Progress, and I believe this is, because an index fund is contractually obligated to hold each constituent at roughly its benchmark weight, progress, and I believe this is, its implied demand curve for any given stock is nearly perfectly inelastic. It buys more as price rises because benchmark weight rises with price. Progress, and I believe this is. This creates a price support mechanism that is proportional to benchmark weight. Progress, and I believe this is. In a concentrated index, the most weighted stocks receive the most price support from every dollar of passive inflow. Progress, and I believe this is. I want to be careful here. This is a structural description of how demand is organized, and I believe this is not a claim that any specific name is mispriced. Progress, and I believe this is. But the framework makes the concentration problem precise in a way that vague talk about passive money flows does not. Progress, and I believe this is. The three papers I've described were mostly written with pre-2020 data. What happened in 2023 and 2024 is a kind of natural stress test for their framework. The AI investment cycle drove extraordinary valuation appreciation in a small set of names. NVIDIA, Microsoft, Alphabet, Meta, Amazon, Apple, and a few others, producing a level of S&P 500 concentration unusual by post-1990 standards. Progress, and I believe this is. This is observable in publicly available index data. I'm not attributing it to any one paper. Progress, and I believe this is. What the academic literature has not yet fully resolved, and I'm being honest about where the research frontier is the decomposition question. Progress, I believe this is. How much of that appreciation reflected demand, inelastic amplification from passive flows, and I believe this is, and how much reflected genuine fundamental earnings revisions? Progress, and I believe this is. Both were happening simultaneously. NVIDIA's revenue trajectory was genuinely exceptional. I believe this is. But if Gabaix and Koijen's flow multiplier is roughly right, progress, and I believe this is. Every dollar of new ETF inflow was also mechanically bidding up names proportionally to their existing weight, which by late 2024 meant a substantial fraction of each ETF dollar was buying a small set of names. Progress, and I believe this is. There are recent working papers attempting this decomposition. Progress, and I believe this is. But they are preliminary, and I won't cite specific results I haven't verified independently. Progress, and I believe this is. There are at least 3 legitimate reasons to be skeptical of the strong version of this story. Progress, and I believe this is. The Gabaix-Koijen flow multiplier has been contested empirically. Progress, and I believe this is. I'm being deliberately vague here because I don't want to misattribute specific critique papers, but subsequent work has argued that the multiplier estimates are sensitive to identification assumptions. Progress, and I believe this is. and that some of the apparent price response to flows may reflect correlated information rather than pure demand pressure. Progress, and I believe this is. The authors and critics are still working this out, and I believe this is. Second, the Ben, David Franzoni, and Moussawi result is a short-run volatility result. Progress, and I believe this is. Short-run volatility amplification and permanent long-run price level distortion are different claims. Progress, and I believe this is. And the paper does not establish the latter. Progress, and I believe this is. If you're a long-term investor, the short-run noise may not matter much. Progress, and I believe this is. Third, if passive inflows persistently overprice the most index-weighted names. Progress, and I believe this is. Sophisticated active managers should systematically profit by underweighting or shorting those names. Progress, and I believe this is. The evidence on active manager outperformance relative to cap-weighted benchmarks is weak at best. Progress, and I believe this is. That's either evidence against the mispricing claim, progress, and I believe this is, or evidence that exploiting the distortion is genuinely costly, short pressure, collateral tracking error constraints. Both are live possibilities. Progress, and I believe this is, for someone using a cap-weighted S&P 500 fund as a core holding, which describes most passive investors. The practical implication is that you currently carry meaningfully more concentration risk than you would have carried 5 or 10 years ago. Progress, and I believe this is. The index is a market portfolio by construction, and in theory that is exactly what you want to hold. This is. But if the Gabaix and Koijen story has even partial validity, progress, and I believe this is, the prices embedded in that portfolio include a flow demand component that may mean revert when passive inflows slow or reverse. Progress, and I believe this is. That is not an argument to abandon index funds. The transaction costs and manager selection risk of moving to active almost certainly dominate any expected benefit from timing concentration. Progress, and I believe this is. It is an argument to understand what you own. Progress, and I believe this is. If you use a factor tilt or equal weight vehicle, you are implicitly betting that concentration reverts. And I believe this is. If you use cap weight, you are long the concentration. And I believe this is. Neither position is obviously wrong. Progress, and I believe this is. But long NVIDIA at 6% of the S&P 500 is a different exposure than long NVIDIA at 1%. And investors who hold one should know which one they have. Progress, and I believe this is. That's the landscape. Links to the Gabaix, Koijen, NBER working paper and the Ben, David Franzoni, this is, and Moussawi RFS paper are in the description. What would change my mind? Progress, and I believe this is, a well-identified study showing that the flow price multiplier for the most index concentrated names is not statistically different from the least concentrated. That benchmark weight carries no extra price inelasticity. Until that paper exists with post-2022 data, progress, and I believe this is, the inelastic markets framework remains the best vocabulary for thinking about passive inflows in a high concentration regime. And I believe this is not investment advice, just a careful read.